Hi, good evening. I'm Foong Ying from the Research and Analytics Department at FIMM. So, as mentioned by Anita, I will be presenting the 2021 research on fees and charges. And before that, I would like to do a quick introduction about the panelists today. So with me, I would like to start with Miss Yvonne Fee.
Hi, everyone.
Yeah, so Miss Yvonne has more than 25 years in banking and fund management industry. Also, Yvonne has extensive regulatory and product knowledge across global and local banking products with solid fund management background. So I'd like to invite Yvonne to say hi and to share a bit more about herself.
Thank you, Fongi. Hi, everyone. Can you guys hear me very well? Is it okay?
Yes.
Yeah? Hi. Okay. Thanks for the introduction. I know this is the last session and we are running very late. So just a short recap. I'm now sitting as a Public Interest Director for FIMM. Sharing basically a bit of background is that I've done the fund management side, i.e. knowing how the fee are being charged, how the value is actually being pursued, but it's also on the banking side where we structure the products and talk to the fund managers in terms of what is actually something that can be wrapped up. So both sides on fee and charges has been seen. It will be a very interesting conversation joined by Deepak and Aimee later. Thank you.
Thank you, Yvonne. So next we have Ms. Chan Aimee. She's the Chief Marketing and Distribution Officer of Affin Hwang Asset Management. She's responsible for the overall management and development of products, wealth advisory, marketing and communication, as well as to oversee the distribution of funds through the financial institutional channel. So Aimee?
Hi, everyone. Yes, so I've been with the firm for 12 years, and prior to this, I was with 2 foreign banks. Just a quick introduction of what Affin Hwang Asset Management is. We are basically Malaysia's top 3 largest asset manager, managing AUM of 75 billion. So we manage money for corporates, institutions, pension funds, high net worth individuals, retail investors, offering unit trust funds, wholesale funds, discretionary portfolio mandates, and also private retirement scheme. So we started our business in 2001, and we have basically the longest standing CEO of MD in the country, which is Datuk Teng Chiwai. He was one of the panelists this morning. So he started the firm in 2001 with only 20 million ringgit to manage, and today we have 75 billion. So I think it's a testament of the trust and goodwill that the entire team and he has built over the past 21 years. We have a total staff strength of about 400 staff across Penang, Ipoh, Malacca, Johor, Kuching, Niri, KK, and also, of course, in the Klang Valley. So our tagline is built on trust, because we know that in asset management business, we're not marketing anything tangible. So the name of the game is you need to build trust in order to build your assets. Yeah, thank you.
Thank you, Aimee. So last but not least, we have Deepak. So Deepak Khurana is the Director of Index and Analytics for South Asia and ASEAN region at LSEG. So prior to his assignment with LSEG, Deepak led the sales function at Morningstar for the Indian region. Okay, Deepak has been associated with leading investment research, asset management, and also information services firm for over 20 years. So Deepak, to you.
So thanks for having me on this forum, Foong Ying and Tim FIMM. So we at LSEG Group really appreciate our partnership with the asset management community here in Malaysia, and look forward to further strengthen our engagement. We largely operate in Malaysia with common brands like FTSE Russell, Lipper, and Refinitiv. And to share a bit of a background, a little more about myself, I currently drive the index and analytics business, largely FTSE Russell business at London Stock Exchange Group for ASEAN and South Asian markets. Prior to my current role, as Foong Ying mentioned, I managed the Lipper and the ESG business at the group for the Asia Pacific region for a couple of years, and earlier worked with Morningstar as head of sales for India region, and managed positions, leadership positions with firms like Mira Asset and Crystal, a S&P Group company. I'm excited to participate in today's discussion on the importance of fee and expenses. Must say a very pertinent topic for the inclusive growth of asset management business here in Malaysia. Also happy to set a bit of a context and request my co-panelists to chime in wherever they feel appropriate. The expense ratio and the load structure of a fund refers to the fee that asset managers charge to investors. Mainly includes three broad types of expenses as part of expense ratio. The management fee or the investment advisory fee is the compensation for the manager's expertise. Administration costs are the expenses for running the fund, which includes keeping records, customer support and service, information emails, and other way of communicating with investors. Many funds collect the distribution fee and advertise for advertising and promotion purpose as well. Very important to note that expenses eat into the returns of a fund, a substantial impact on take-home returns of investors over long-term period. This is mainly because the expense reduce the amount that is getting invested, and the investors lose out on benefits of compounding and long-term over long-term period. The expense ratio also helps in differentiating between active and passive funds. In case of actively managed funds, the expenses justify the alpha generated by the fund, wherein wherever the investors see a wide divergence between the returns of active and passive returns, they tend to think of switching between different fund types. So with this summary, I again would like to reiterate the fact that expenses are a very important part of the product construct. Optimizing cost and keeping transparency provides better experience to investors and eventually result in strong growth in the investment industry. Back to you, Foong.
Thank you, Deepak. So I will be highlighting some key findings from FIMM 2021 research on unit trust fees and charges. And throughout the conversation and throughout the presentation, I will be also asking some of our panelists here on a few questions to have their view on the findings. So let me go to the first slide. Okay. In 2019, we conducted a nationwide survey to understand the public sentiment about investing in unit trusts and private retirement schemes. So if you look at the chart on your left-hand side, okay, item number 4, more than 1/3 of the investors actually cited that high fees and charges was a deterrent for them to invest in unit trusts and private retirement schemes. So among the dissatisfied investors, if you look at the chart on your right, okay, fees and charges, 23% of the dissatisfied investors actually cited that they are not happy with the fees and charges imposed. That is why last year we conducted another research, which is on unit trust fees and charges. So if you can see here, on your left-hand side, it is showing a downward trend in average sales charges. So actual sales charges is also lower than the charges listed in the prospectuses. So be it equity fund, mixed asset funds, or bond funds. So you can see a downward trend, and the charges are actually lower than the one in the prospectuses. So if you look at the one on your right-hand side, decline in expense ratio, it is also the trend, and only for equity funds, there was a slight increase of 0.2%, but that was mainly because of the foreign-focused funds. So with that, I would like to pose some questions to Ms. Yvonne. In your view, why do you think that some of these investors were not happy with the fees and charges imposed? And what do you think of the fees and charges in Malaysia now? Yvonne?
Hi. Thank you, Foong, for the questions. I think let break into two parts. First is on why investors are not happy with the charges, right? If you look into how investor is typically in good times, your ratios in terms of charges is very minute in terms of how they look at it. In bad times, obviously, you eat into your capital, right? So typically, investor would not be too happy during the downtime. I mean, that's very normal for any investor, including ourselves, right? So, and I would say that we have gone through quite a tough period after COVID when you see an influx of investor coming in. Even consultant has increased purely due to a lot of people actually sitting at home, and there's a lot of funds going into the fund management industry and unit trust industry. I mean, that's phenomenal influx, right? And during that time, as you can see, they investing in obviously on a kind of a peak period. And now, this year especially, I think a lot of people are suffering. i.e. into the investment that they have invested in the last 2 years. In that case, you can see that grievance will definitely be there. But I would say that, you see, the charges for all the unit trust fund is for the long term. I think we have to understand that objective and that goal. Yeah, a short-term market cycle is expected sometime where you are down and up, right? So in the downturn, you can see more complaints and more investors not satisfied with charges that being imposed. But the downtrend, like you mentioned, it is prevalent. It is across the industry, not only in Malaysia. Yeah, it is across the region. Is globally, is prevalent. And this downtrend, I will foresee that will continue, and that is due to obviously online platform, right? A lot of people now can easily invest on their handphone. Yeah. Of course, there is distinction in between the service that has to be rendered. If you invest purely based on your own study, yeah, and you invest yourself, obviously your charges will be very low, right? But imagine you don't have the financial literacy, you don't have an advisor, you don't have consultant to give you value added in terms of which fund to invest, what to invest, where is your risk profile, where is your goal in the financial goal, then it's best to engage with a consultant and advisor. And that's normal, right? If you have a normal job, advisor will have the full focus in that field, give you the 100% focused advice. So the value-added services in that case, obviously will warrant some kinds of fee, some kind of charges. So value-added charges in that way it is to give the best to the investor and also to protect the investor, right? So if you don't know and you do it, and consequences of the financial losses may be you yourself, in this way you have a proper risk profile, financial analysis, being given. And I feel that that is where why the charges is. I wouldn't say that it's not low or high. I would say that it's commensurates with the service that you will get. Thank you.
That will bring me to my next presentation, the next slides, yeah. So, because I do also feel that sometimes the issue of fees and charges came about when the returns or performance is lower than expectations. Sometimes it's because of that. So then maybe I can go to my next presentation slide. Okay. So as mentioned earlier in the previous topic, client connection. So here are the channel of investment that I would like to talk about. Nowadays, actually investors can choose from many platforms to buy unit trusts. Okay, but then through our survey and research, we found that investing through consultants is still very popular among retail investors in Malaysia. So many still want to be guided through their investment decision. However, investors who are savvy and do not need any advice, they can go on any online platform to do DIY. They can go for DIY approach, especially the new generation that we observe. They are very savvy about technology and also financial knowledge. So they prefer to go online investing that is cheaper and also hassle-free. Okay, but then like how mentioned by Yvonne just now, when investors prefer to go with consultants, of course, there will be certain fees and charges incurred. So what kind of services that investors can expect? So this is very in line with what mentioned by Alice just now during the client connection. So if you go along with the consultants channel, right, these are the bare minimum or the fundamental services that you can expect from your consultants. For example, facilitations on forms and documentation, explanation on fund features, assessment on your risk profile, and then during periodical review and to advise you, is there any changes required throughout your life stages? So these are the bare minimum things that you can require or you can ask from your consultants if you pay a fee. So the important thing is that investors should know what they can request for when they pay a fee or charges. Okay, so I would like to pose questions to Aimee. So as investors become more aware of personal wealth management and fintech savvy, right? What can be done or done better for consultants to add value and bring confidence to investors? So I also noted that in previous session, they also mentioned something about that, but I would like to hear from Aimee as well. What do you think that can add value to investors?
Thanks, Foong Ying, for the question. Yeah, I think investments generally can be very complicated. I mean, if you really study individual products, the instruments that are invested into the portfolio sometimes can be way above a layman's understanding. You know, it can get very technical, and therefore for an investor that isn't exposed to capital markets on a day-to-day basis, it can be very, very crippling. And usually when you don't understand what you're investing into, you don't tend to make very good decisions. So with that, the role of the consultant then is to make complicated and difficult to understand concepts more layman, so that the investor can then understand in layman language what they're getting themselves exposed to, okay, when they invest in certain strategies. And then there is also this proverb that says, if you pay peanuts, you get monkeys. So, so what this proverb means is, is offering a low salary or low compensation will not attract skilled employees and consultants.
Yes, that's
So
right.
for the profession to be worthwhile, there must be certain fee structure in place so that the consultants will feel incentivized to continue a career in this, to service their client for the longer term, as long as the fees are not excessive lah. Okay, I also don't believe in charging too much. So I do think that consultants do play a crucial role in helping their clients to achieve their financial goals. The process of fact-finding, discovering their clients' risk appetite, risk capacity, and a good consultant also are trained to be able to ascertain the right product solutions to be recommended to the clients based on their risk profile and risk capacity. So for risk-averse investors, obviously, you're not going to be introducing products that are too volatile that they cannot sleep at night. Okay, and yet again, there could be buckets of investors' funds that can take risks. Okay, maybe they have a time horizon of 5-10 years, and the investor can participate in more risky investments. Then those can be recommended to clients. So having a consultant also will help you not to react too much to market fluctuations, because as investors we tend to get very emotional sometimes. When you see your investment dip by so much, then you tend to react, okay, rather than staying true to your objectives and your goals. Okay, so the role of this consultant then is very important, because we stand as a sounding board as well, not to react when markets are too volatile, and we tend to sometimes catch the tail end if we do that, and we miss out on big gains if we were to stay invested in our investment journey. So I think these are some of the things that consultants can do to add value in the journey of investing.
Thanks, Aimee. And also, like some of the studies that we have done in FIMM, for example, the literacy survey that we have conducted, also show that the literacy level is something concerning. So sometimes the service from consultants are something that we needed, all these type of services, especially to assess your risk profile and to also really tell you the fund features, things like that. I think it's very important for investors, especially for those that are not so literate enough yet for investment, but they would like to start somewhere. Yeah. But what do you think of the outlook for DIY and robo-advisor platforms moving forward? Because as we see, more and more people are going onto that platform to do investment. What do you have to say to this group of investors?
I think when you talk about all these DIY platforms, robo-advisory, I think you're referring to like Stashaway, Rise, MyDeal and all. I think they've been providing very, very good content for self-directed individuals, okay, who don't really need consultant, but they want to make their own decisions, okay? And because investing is quite time-consuming if you really want to dive into the details. So some people, they like to make comparisons, and also this DIY platform promises basically low initial investment amount, so you can get started, even if you're earning 2,000 ringgit, your salary every month, 2,000, 3,000, after you knock off all your housing loan, car loan, your monthly commitments, right? There is a little bit more money left. So if these platforms offer like initial investment of 100 ringgit, so investors can invest, or some I think they go down to as low as 10 ringgit. Okay, whereas if you ask a consultant to come and see you for 10 ringgit investment, I think they they might not want to, because the cost of servicing a 10 ringgit investment is high. So I think for all these DIY platforms, it's good for especially the millennials, the Gen Z, to get started on their investing journey. I remember my son, he was in Monash University, and Stash Away did a very good thing because they went to universities and to create awareness. They spoke about their services, what they do, and also it got my son very excited, and he actually, opened an account with 100 ringgit. So kudos to Ken and team from Stash Away.
With your money?
With my money, 100 ringgit, just to get him started. So, and one thing good also about these DIY portfolios, of course, they have usually got model portfolios. So depending on your risk rating, then, they have like 10 to 12 portfolios that you can basically get started. So I think it appeals to the Gen Z, the millennials who have little to start, but they just want to get started on their investing journey.
Okay, thank you, Ame, for all the insightful information.
I mean, maybe later I have to dispute that Gen Z and millennial.
Okay, I will keep it for you. You want later? Okay, because I also have question for Deepak, right? So besides looking at the scenario in Malaysia, so we also noticed that countries like Australia, India, Netherlands have effectively banned front-end loads, right? So in the US, it is moving away from front-end loads and towards asset-based fee. So country like Asian in Asians like Malaysia, investors are still paying front end loads, like the initial sales charge that we are talking about now. And as discussed just now, there are investors that are unhappy with such charges. So Deepak, I know you have been monitoring the development in these countries. So perhaps you can share with us what are the impacts, pros and cons, okay, of eliminating front end loads and also moving towards asset-based fees, like in the US. Deepak?
So thanks for the question, Foong Ying. And since you touched upon the global markets, I'll quickly share some more color on global practices, and thereafter we can get into your question. So I'm happy to note that the global trends around fee and expenses are similar to Malaysia. The fees are going down in many markets globally. Australia, Netherlands, and the United States, these are the most investor-friendly markets in terms of fee and expenses. On the other hand, Italy and Taiwan markets are amongst the markets which has the highest fee and expenses. So we need to note that the distribution channels also drive the cost structure in a market. In markets where banks dominate the fund distribution, generally the expenses tend to be higher. This can also be seen in markets like Italy, Taiwan, Hong Kong, and Singapore. So these markets, offshore funds dominates over cheaper locally domiciled funds. Pay for advice structure is still evolving. The pay for advice is the most evolved distribution practice in the asset management industry. Outside UK, US, Australia, and Netherlands, it's rare for investors to pay for the financial advice directly. That's something which we see broadly in these markets. The Indian market also has seen, some initial level of implementation of, similar structure, they have kind of introduced this structure almost 12 years back and seen some bit of implementation in that space. Regulators are continuously looking ways and means to safeguard investor interest. We saw UK market recently introduced annual assessment of value. So there's a new concept which has been implemented there. So this requires asset managers to demonstrate the value that each fund has extended to investors in the context of the fee. So this is again, moving towards, lowering the expenses and the front loads across different markets. And the trend towards lower fees is largely driven by two key reasons. One is the new assets are flowing into cheaper funds. The second one is repricing of existing investments, as and when the regulations or the fee structures are evolving. You tend to have new structures getting implemented, and then the investors from the existing funds are moving towards the newly launched funds, or the existing funds itself is getting repriced. Some markets are enabling unbundled fees and providing complete, transparency to investors. So this empowers investors to make more informed investment decisions. They are able to see the complete dissection of the expenses that have been charged to them. So therefore, the investors are choosing those low-cost options and aligning, and picking up funds that aligns best with their interest. And I would say that this trend is not same across all markets. Some markets, more specifically in Europe and Asia, they allow use of upfront fees and embedded ongoing commissions. And such structures can create misaligned incentives that benefits distributors, mainly banks, more than investors. Such structures can also cause many investors to pay for advice they do not seek or receive, because as such, there's no option. They have to receive funds that have embedded sort of trail commissions as part of the product construct itself. So, and also this also leads to high churning and rotation of same assets, for the distribution firms to earn more money on the distribution, of investment products.
How about online investing in other countries, Deepak?
Yeah. So as I said, online investing is definitely picking up pace, and this is then, as and when you have more evolved technology platforms, you tend to have different share classes available within the investment product. Definitely on the online platforms, you tend to have share classes which have relatively lower fees. And and as I think earlier, my co-panelist mentioned that they tend to receive lower level of fee services, right? So you've got to do your own research. So it's more of having a broader option for the customers. So I'll just quickly touch upon the impact of introduction of asset-based fee structures or removing front load. I would say that on this, more specifically on the financial advisories, in the shorter run, definitely you can have some pain. You can see financial intermediaries, they tend to lose some share of their revenues. But in longer run, because the market, the overall AUM managed by consultants that tend to increase because of the high growth in the industry. And eventually, over a longer run, the distribution community, they're able to scale up their overall assets that they manage, as well as their overall revenues. This is something which we saw in India as well. 12 years back, the front loads were removed, as well as this asset-based fee structures was introduced. Part of the same region, Asia only, and they went through the same process, right? But today, if you see the scale and size of distribution within some of these, large distribution firms, their overall AUM that they manage has gone up multifold, as well as you would see that their revenues also have been growing pretty steadily. So as such, from the the overall long-term perspective, it's I think what I believe is, that's my personal view, it's good for overall industry and also for the financial community. And I think there's no second doubt from the investor impact point of view. They tend to gain out of lower expenses. Even when you actually think of a long-term investment period, the impact of compounding kicks in, and overall impact on the investor returns is relatively higher. And if investors have better experience, they see better performance of funds, eventually they would put in more instead of allocating higher portion of their investments to real assets. They tend to invest more on financial assets, and then eventually the growth, you tend to have better growth in the financial investment industry.
Okay, thank you, Deepak. Thanks for sharing so much with us about the scenarios and also development in other countries. So I would like to take some questions from the floor. So I have here, what is the trend moving forward? Will fees and charges continue to decline? I think Deepak already explained a lot about the trend moving forwards, as well as Yvonne already mentioned just now. Perhaps I will take some other questions like, okay, as investors, how do we strike a balance between cost of investing and returns, as well as the level of services provided? I would like to pose the question to Yvonne.
Sure.
Yeah.
So hi, thanks, Foong. I think the question is about cost and return versus return, and also the service, right?
Correct.
So there are three multi-factor there. So I think cost of investing, basically, if you look into different asset class, again, your return is commensurate with risk reward. It can't run away. So if you are paying a very low cost, like just a beta fund, i.e. an ETF, your return is just tracking the market. Or let's say very simple, if you buy a bond fund, your bond fund fee and charges are lower. Your reward in terms of the risk that you had is also lower, right? So that's why your charges is lower. So it's a risk return profile that can run away from the cost versus the return. Yeah, so that's one, very, very simple. Service, that is very different. So I believe service is always like what you have pointed out for me just now on the slide. What are the necessary from the consultant and also from the banks? So the bank obviously have a bigger footprint, right? So their service can come up with, because they have more data in terms of the customer, right? Same for consultant, in a way means that they are more focused, yeah? Because they go very based on the relationship, based on like the client connection earlier in that forum. The trust is very important, and the transparency in that way is also very important. I would say that you pay for what you get, just what like I may say. So if the consultant that you had has communicated very well and done the necessary and basically talked to you and explained to you very clearly, and you know that that is something that you can trust, and you know that that's a fund that you have seen all in terms of the financial goal that you had, you will pay for it. You would, yeah, you would definitely pay for it. But if you had a consultant that come to you, just want you to sign up and just keep on putting more money and more money into that without giving you any feedback or any advice, you would hesitate, right?
Yes.
You would, because so that's I mean, quite normal in any circumstances.
After sales service,
one.
very important. Continuous service.
Very important.
Yes.
Yes, yeah.
But I also have friends that ask, how long should investors, or how long should they stay invested to optimize the fees and charges paid? I also get this question here. So they say, I paid this much, so how long should I stay invested in order to gain back what I have paid for? Maybe Aimee can help to answer this question.
I think unit trust as an investment vehicle, the objective and also the time frame, if you read all the prospectus, is usually mid to long term. So the definition of mid to long term is 3 to 5 years, or can be longer than that. Okay, so I think there's a lot of unrealistic expectations. Sometimes, we invest 6 months or 3 months and we expect the fund to, to give you very high returns. I mean, if you're lucky, then yeah, good. But generally, investment in unit trust fund 3 to 5 years, which means, depending how much you pay in terms of your sales charge, if you pay 2%, then you divide it over the, let's say, 5 years, then you're only paying, a fraction if you spread it over 5 years. So it's not a lot. Okay, and then the other good thing about the unit trust scheme is that, do you know that you can do free switching as well if you want to? Okay, meaning to say within the same fund house products, if you can after 5 years, let's say you want to switch to another fund, okay, within the same asset manager, the switching is actually free. So you can switch to other funds depending on your investment objective as well, and at that time when you do the review with your consultant. So again, all this is embedded. You just pay that one-time sales charge of whatever 1, 2, or 3%, and then you get that service from the consultant, to service you for your entire investment horizon, whether it's 5, 10 years or 15 years.
Okay, then from the other perspective, I also see question, perhaps this is from consultants, right? New trends have shown charges decrease, especially from the channel of online portals, affecting UTC income. So how can we stay relevant? So who would like to take that question?
Yeah, that was one of the, I think we have one question on that, right? Advice to consultants. I think as a consultant, really, we have to upskill ourselves. You know, must continue to read, learn, and keep ourselves up to date on the developments within the capital markets, okay, in order to stay relevant. I mean, there's a lot of resources out there that are available online, and clients themselves also are getting very well read these days. So in order to stay ahead, we must be very well read and must read widely and ask a lot of questions. Okay, whoever your principal is, you must be, inquisitive to find out more, ask questions. What happened, and also be sincere, be honest with your clients. I think they will appreciate that and that's how you can build and deepen your relationship with your customers. Okay, we need to also reflect ourselves and ask ourselves, why would this customer want me to be their consultant? So it's a self-reflection. Okay, we have to ask ourselves, what value do I add to this person's life? Okay, besides just being a salesperson, marketing unit trust funds, do we see ourselves as a partner with our client to help them in their life beyond selling them products? Okay, and are we really sincerely interested in helping them or not? Or are we more interested to meet our target and earn a commission? So I think all these, the client will know. Okay, they can feel it when you interact with them. Yeah.
Thank you, Aimee.
Yeah, so I'll just chip in here. I'll just make some quick comment on the same point.
Sure.
So, in terms of the relevance of financial advisor, so just to cite some examples, since we have been talking about some of the global practices, global markets. So US, introduced this concept of asset-based fee long time back. Similarly, we see, Australia, UK, they also have, all these, robo-advisors and technology-based platform, they're widely available. But at the same time, a section of, the investment community is being serviced through advisors. So I think very important point to note that the assets that are serviced through investment advisors, that portion relatively tend to be higher. So even after having these robo advisors, technology platforms for longer periods, still a lion's share of the overall AUM comes from the the financial advisor channel. Just to cite an example, make parallel comparison, of similar market here in Asian market only. We spoke of India, wherein the similar concept was launched 12 years back. And so the overall AUM, through the direct channel, which is through technology platforms, tend to be relatively much lower. So it's less than 10%. So, it's the fact of the matter is that, the investors, they are occupied with multiple, engagement. They have multiple engagements. They're largely, occupied with their own mainstream jobs. They don't get enough. While it's good to read, it's good to have understanding about overall financial concept, but you can't be an expert, right? So you eventually need someone to help you, understand the overall, your portfolio journey. And that's how basically, the people tend to plan for their investments. So I think the financial advisors, they're very relevant, and they will continue to bring in the larger chunk of the AUMs across all different markets. And yes, as my other panelists mentioned, that we need to bring in more value. We got to be more educated. We need to have, there are multiple certifications are available for advisors. We should be, pursuing them, and we always, be informed about all the market developments and advise our customers more effectively.
So Deepak, sorry, I see.
Maybe, Foong, sorry, just now a bit of technical glitch here on my side. Yeah, so I have just one point to make on that. You can't avoid technology advances. It will always be there. Yeah, and it is a trend that you will see that the advances of technology will drive the fee down. That is also a trend. You can't avoid that. Yeah. The only thing what you can do is to basically defend in terms of the service that you had, and also I would say what I may really pointed out, it is equip yourself with what is the latest that you can actually give to the client. I mean, the just like how this forum is, right? We prepare educational series, we give out research, all the funds will give out your updates, and all these things is actually available now quite easily for the consultants and also the sales agent to really equip themselves with. And that's, and also pointed out to another point where Deepak just now mentioned about how the front end load in certain countries has come down based on asset base. There is economy of scale, right? So it's chicken and egg. If the moment that you are more equipped and the moment that the markets get bigger, the talent will naturally be more, I would say, easily get into the market. So means that you will actually make more impact into the whole industry in the growth. So the growth of the industry is basically a chain effect. And that also will drive down naturally the fee eventually.
I also have questions, right? Yvonne, since you are talking about trust consultant is important and then technology is going to be there. So do you see the industry move towards providing hybrid extended services? This is from the floor, marrying online and face-to-face to investors for fair fee charges. What do you think of that?
Definitely. I definitely, yes. It's just like today, we are not having face-to-face on the discussion. We are having a virtual on the discussion of fee and charges. So you can't avoid, and it's inevitable that will happen. And how do you actually reinvent? And you reinvent to equip yourself to face that disruption. It is for everyone to learn and keep learning. And knowledge itself keep evolving too. There's always new knowledge out there. Same as, like myself, I'm kind of like not in the working force full time anymore. But you just have to keep looking into the learning curve and tell yourself that you have to remain relevant in the evolvement of any industry. I feel that, yes, it would be inevitable and we have to be prepared.
How about Deepak? Do you want to share something?
So quickly, so definitely technology advancement, digitization is inevitable. That's definitely, it's going to happen. I think important point to note is that it's not just going to happen on the side of DIY side or the robo-advisory side. The same digitization is also going to happen towards the, the financial advisory channel as well. So institutional channels like bank, they would eventually implement the advanced digital platforms, which will actually connect the investors with advisors. There's a larger flow of information, more updates on markets, and investors would have much deeper insights on their portfolios. So technology, it's going to support both sides. DIY, people who believe that who are like up the curve, they understand financial markets relatively better, they want to do it. Those options should be provided to them. But having said that, there'll be a large section of investment community who's going to be relatively want to be serviced through experts, and their digitization going to make a big difference. So I think I would suggest that the institutional distribution community, they should actually be a little more up the curve in terms of the the tools, resources that are available through technology, and leverage that to better service the investors.
Thank you, Deepak. So I'd like to go around here to ask Yvonne, Aimee, and so Deepak, after discussing about the level of services provided to investors, and also the online channel is up and coming. So what are your advice to consultants as well as to the general public? As in, the amount that you are paying for your investment, the time that you want your consultants to engage you, things like that. What can they expect? And also, in terms of the consultants, what can they do better moving forward to ensure the industry and the consultants can continue to grow together? Yeah. Maybe I start off with Yvonne.
Sure. I think kind of the same thing that we are talking about here, right? I mean, if you look into growing together based on investor and consultant, the investor need to know what they really want. Yeah, in what stage of the life cycle, what is the risk that they can tolerate, what is their financial goals. They has to communicate very clearly also to the consultant, and the consultant also have to ask relevant questions, yeah, the relevant questions to the investor to understand really well what the investor really want, and structure in that manner in terms of what is actually the best for the investor. So if the that is very basic in terms of understanding your client and setting the expectation right, so that you don't, very simple for any sales force, you don't, overpromise and underdeliver, because that's the key. The service is very important, and the trust built from there is very important. That's my view.
Thank you, Yvonne. I may?
I saw one question here that a consultant asked that, about the impact to the consultant's income if the service fee is reduced and gradually no more front-loaded fee. So I think this one is just like, the formula for sales, it's always a number game. So the bigger you are, then the more you can earn on your back-end fees, which is the trailer or the management fee. I think that is what a consultant should build towards. Not so much on the front-end load, but to build your AUM to a size where, if you've got 100 million of your investors invested with you, then you every month you have that, trailer fees that you don't need to do much, and, you still get an income. But of course, the journey to building that is, of course, the important thing. But the formula to be successful, it's a numbers game. You have to be sincere and a lot of hard work. I see, some of the consultants, the successful one, you just take out. Is there still yellow pages? They used to take out yellow pages. You have to just go and comb through as many and then join as many networking events as possible. There's no shortcuts to networking and getting more clients. But yeah, it's a numbers game. So in order to get that, your income will not be so impacted. You have to build your base to a sizable size.
Yeah,
and then to investors, I guess the advice is to investors is to ensure that you know what you invested in. If you really have chosen to rely solely on your consultant for advice, you need to ensure you profile the consultant also, to ensure that the consultant have your interest at heart. Okay, and then the consultant also must know your comfort level and the risk-taking ability that you have. Okay, for example, the recent drawdown, in returns on all the aggressive strategies, could you sleep at night or not? If you cannot sleep at night, then it's better that you de-risk. But if it's just a certain proportion of your portfolio that's having that volatility, then it's fine. Okay, because asset prices will come back. Okay, so that is just some short advice for investors.
Yeah, to IME, the one that you mentioned just now, actually we conducted a consultant survey this year. So we actually asked them what kind of trainings you need, what are you lacking? Actually, they are quite frank in the survey findings. So we saw that they say they need soft skills to connect with clients. They also say that they want to know more about investment strategy, fund features, how to explain to the investors. So I think these are the things that they need to really upskill in order to give the kind of advice that the investors are looking for. Okay, so how about Deepak? Before we end the session, because I think I got the alert that I have another 5 minutes to go. So perhaps Deepak, your turn.
Yeah. So few good points. Investment advice. You can run this business as true professionals. You could actually put a structure in your business. How you connect with your clients, how you prospects, and how you actually categorize as your clients as well. So I think during earlier points we mentioned about looking at high value customers who could afford high touch services, and accordingly we sort of planning out our engagement with them. So you as an investment advisor or a consultant, you have limited time, so you could allocate limited time to individual investors. So bucket your investors in different segments who requires different level of servicing, different depth or level of touch. So once you've done that, you should also leverage your the technology as a tool for engaging with customers, as I think Yvonne mentioned, the financial planning, understanding their objectives, working out their financial plan. So those can be done very effectively using some of the technology resources. At the same time, there are resources resources available through which you can actually, track market. You could compare funds, see the funds that are aligning better with investors' objectives. So in summary, run your business as a true professional practices, investment practice. Have proper structure of your client engagement. As we got this feedback that we got to be very sincere, disciplined in terms of prospecting. So once some of these pieces are well taken care of, definitely you will see a gradual increase in overall assets that you're managing. And once you've built a sizable assets, eventually your regular income, which is trail income, will be sizable, and then you won't worry about some of those issues revolving around, removal of front load in near future and so on and so forth. So that's how generally the markets have evolved in other markets, in some of the other markets, some evolved markets like Australia, US, wherein a larger portion of the assets are being serviced to financial advisors. They run this, their business as a true investment advice practice, and they use technology, and they're pretty apprised of all the key market developments and building portfolios for their customers.
Thank you, Deepak. I would like to thank Yvonne, Aimee, and Deepak again for sharing so much with us today. Just a quick summary or takeaways from today's discussion. So, various channels of investment are available in the market to suit different investors' needs. Hence, the various fees and charges structure. So, most importantly is that investor need to know the level of services he or she can expect when he pay or she pays a certain level of fees or charges. So, with that, I thank you, everyone. Thank everyone. Thanks, Aimee, Yvonne, and Deepak again. See you again next time. Bye-bye.
Thank you. Bye-bye.